Hi, this is John Vance, founder and president of Vance Wealth and Advanced 401k Solutions. Thank you for joining me today as we discuss a topic on traditional 401k contributions versus Roth 401k contributions. So, big part of where we start is essentially how are they similar? Well, both options are savings, retirement savings options. They're a convenient way to fund your retirement right from your paycheck. But one of the important things is a lot of 401k plans don't have the Roth option. So Roth provision must be included in that. Most of the plans that we work with do have the Roth provision because we think that's a great value add to have for employees. Both options have the ability to include a company match, right? So if your employer is doing a match, it doesn't matter if you pick the pre-tax option or the Roth 401k option, both will be eligible for the match and you can take advantage of that. They also have the same contribution limits. So in 2021, the limit is $19,500, and there's also a catch-up contribution that if you're age over 50 years old, you can put in an additional $6,500. One of the important things that I think a lot of investors get confused about is that the Roth 401k and the Roth IRA are not the same. Many people don't think they're eligible for the Roth because they're not eligible for the Roth IRA. But in fact, they are eligible for the Roth 401k because there are no income restrictions, and that's an important difference. So when we start looking at the biggest difference on evaluating and basically how these work is the Roth portion versus the traditional portion is this idea of when do you pay the tax? And that's the biggest difference is whether, how you're taxed. So the Roth option, you pay tax now. So withdrawals are not taxed. Earnings and growth, they're not taxed. You pay the tax now. So when you have your paycheck run, then it funds a Roth, there will be no deductions on your income. However, on a traditional or a pre-tax plan, you pay tax later, which means you get the tax deduction today. And a lot of employees really search this out because they love the idea of lowering their taxable income. But one of the things that I'm advising you is be careful because it really depends on your tax bracket. Because you might get the tax deduction today, but you're going to have to pay tax later, not only on what you put in, but also any future growth. So, and a big part of this at the bottom you can see says employer match. So if your employer is matching, they're only going to match it in a pre-tax bucket. So even if you opt for the Roth 401k, you will only be contributing, or your match contribution will be going into the pre-tax. So this is a little bit of guideline. Now, I can't give you tax advice, but I wanted to at least provide a range because oftentimes it's kind of confusing as to what's the best option. So if you look at the different tax brackets, there's a 10% and 12% bracket. We really do think that if you're in one of these brackets and you can see the income thresholds, individual less than 50,000, married less than 100,000, that's combined income, that a Roth really could make sense because you're not in a high enough bracket where you might need the tax deduction today, but you get the benefit of that tax-free growth. If you're in the higher bracket, so if you look down at the bottom, the 32, 35, and 37%, in most cases, not all, it could make sense to do the pre-tax option because that's when as an individual, your income's above 160. That means married, your income is greater than 340,000. So being in these higher tax brackets, oftentimes we crave having those tax write-offs. And so the 32, 35, and 37, remember, these are just federal tax brackets. If you live in California or any high tax state, that could be an additional 10% on top of that and even in some cases more. So those are kind of a little bit easier to describe in terms of if you're in the lower bracket, a Roth could make sense. If you're in the higher bracket, the pre-tax or traditional makes sense. So what if you're in the middle? What if you're kind of in the donut? Well, if you're in the 22 or 24, it's a little bit of a crapshoot. And some of that might have more to do with your age. The younger you are, you do get more benefit of doing the Roth because now you have years and years, maybe even decades upon decades of compounding growth with the Roth. And if you're doing that tax-free, you definitely get a lot more bang for your buck down the road. So this is really kind of I would say it's probably based on cash flow, based on your financial situation, but in that middle bracket, really talk to your advisor. figure out what the best option is. And if you can afford to do the Roth and not worry about getting the tax savings today, then that's really what I would recommend. So thank you for joining us today. I really hope this was helpful for you. If you need any direct advice, Jason Lane, you can see his name listed here, is our Director of Retirement Plans here at Vance Wealth and Advanced 401k Solutions. So please reach out and have a great one. Thank you.